Stocks remain resilient to the Fed's threats of tapering, but for how long as yields continue to rise? What will higher rates and the draining of liquidity mean for gold, silver, stocks, and crypto? Is there a full-on taper tantrum brewing, or can the Fed keep control? For a look at what the charts tell us, I'm joined again by Gareth Soloway of InTheMoneyStocks.com. And remember, as always, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how you can buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts. Gareth Soloway, welcome back to GoldCore TV.
Hey, thank you so much for having me back. I appreciate it.
Now, it looks like the Fed are using the threat of tapering to try and control this market, and that there's not really much else that they can do. So they're trying to move it around by the narrative. They're jawboning this market at this stage. What do you think is going to happen here in stocks? Let's look at stocks to begin with.
Yeah, so it does seem like the Fed is trying to get the market more used to the idea of tapering, which tells me that they're fully aware that they need to taper. We remember that the 120 billion they've been pushing into the markets on a monthly basis, that was an emergency measure back in March of 2020 because of the COVID crisis. Needless to say, with economic growth where it is and everything going relatively well here in the US, they don't need to do that anymore, and they need to start backing out of that. Now, this is totally different than raising interest rates. I don't know if they'll ever fully raise interest rates again, because I always think there's another crisis on the horizon. Now, having said that, there's actually some interesting price action going on in the market. So we saw the Nasdaq top out in a channel up here. And you can see, I mean, this channel just absolutely amazing. And this is why I just absolutely adore charts, because, I mean, they really give you a good clue as to where price action is going to take you. So you can see that this trend line connecting all these highs, and every time you hit this high, you see a pretty significant sell-off. So here and here, and then we hit it right up here. And then look, we went right down to that lower trend line. Now, the markets have bounced off of it, but it's a weak bounce. What do I mean by that? Well, certainly we're not shooting up. You're not seeing buy the dippers rip this market back up substantially. And what that tells me is the market will eventually break lower here. So my guess is over the next 2 weeks or so, you'll see a breakdown below this trend line, and you'll start the next leg down on the Nasdaq. The S&P will likely follow. It's probably going to coincide with yields going a little bit higher. We've seen the yield move to the 1.6 area on the 10-year, and certainly that is making people a little bit nervous. So overall, I think you might have a little bit of chop here, but I think in the next 2 weeks, you're going to get another secondary leg down to this market.
And what type of size of correction do you think that we could be looking at?
So before a significant bounce, I'm in the camp that we need to at least test the daily 200 moving average. It's not a whole lot lower before we test that. In fact, if I show my chart here again, you can see that the 200 moving average is right down here around 340. So that's another 17 points lower on the QQQ. On the SPY, if I bring up the S&P chart here, you can see that's around the 415 level. So that would be about 30 points lower on the SPY. So I think that's where you'll see the first big stand by the bulls, by the dippers. A lot of the talking heads will come out and say, okay, we finally hit the 200 moving average. You're going to get a good bounce. Maybe we're going to go back to all-time highs. I think that's going to be a false positive, meaning that you are going to get a bounce off of that because it's a self-fulfilling prophecy. Investors that have been sitting and waiting for the buy the dip, they will buy there. But my guess again is this market is now going into a downward cycle. And we can see the downward cycle because very clearly here, and let me take away these moving averages, we've now put in a change in trend, lower low and lower high. So if you look back to March of 2020, we were always making higher lows. I mean, all along here, it's higher low, higher low. Same thing with highs, higher highs, higher highs. Well, that flipped. Here was a low, now a lower low. Here was a high, we bounced, we made a lower high. So what that tells me is that there's been a change in trend in this market that is now going to take us into, in my opinion, a bear market going forward. It coincides and it makes sense that it's with the tightening phase of the Federal Reserve, which is going to be pushed along by this inflationary pressure. And again, the Fed is even saying now, it's not just this year that we're seeing 7 to 8% inflation, it's next year. So they're going away from this transitory short-term inflation to now the concern about a longer-term inflation problem.
Okay, so inflation, moving away from the transitory aspect of it and more sustained long-term inflation here. And then we've got the threat, and we've got the Fed talking about the tapering. Do you think that the markets are then preparing for that tapering and the removal of liquidity, or is it something more serious? And that if we get a breakdown, we get a serious taper tantrum, that we could see a significant correction in stock markets?
Yeah, so my guess is you're going to see this inflation bug start to freak the markets out more and more. Right now, we're still close enough to the all-time highs where you're still getting these people, these investors that have put more money in the last year in the market than in the last 20 years combined. So there's still average investor money flow that's coming into the market, and that's what keeps this market up. It's clear to me, I've seen so many examples of it where institutions are unloading heavily. So if you look at the market, how it's kind of made this rounded tops over the last, month or two, that's created by smaller investors buying and the institutions selling into it. That's why you get this gentle curve over versus a big drop. If it was just institutional selling, it would have been a sharp sell-off. So my guess is, again, you'll see the Federal Reserve be in a very tricky position where they don't feel like they can raise rates because the market will throw a tantrum, but the inflationary the inflationary jump and sustainability will actually cause the markets to raise interest rates for them. And that's going to be something very weird where the Fed could actually be looked at as losing control, and the market will get very scared at that. And I actually think that, after we hit this 200 moving average, there's at least 20% down after that will come. So again, it's not going to be instantaneous. Don't think I'm calling for a crash. But over the course of this next phase of the market, which will likely be, 12 to 16 months, you should see as much as 20+% down on the equity markets.
Would you have expected then to see appreciation in the precious metals on the back of this? We've been kind of trending sideways for a little while now.
Yeah, I'm in that camp where I think that gold especially is slowly getting ready to make a big breakout to the upside here. I've been kind of calling for year-end 2100 gold. It doesn't look at this point like that's going to happen, but I think you'll be well on your way to that level. So if we look at the GLD chart, for example, we can see that, even though yields have risen, which generally pushes down gold's actually held up relatively well since yields have pushed back to 1.6% on the 10-year. The other side of the coin, too, is that investors need to remember that when yields go up because of a strong economy, gold sells. When yields go up because of inflation, gold actually rallies. And you can see this going back to 1975 to 1980, where gold had a major move up during that period when there was high interest rates and high inflation. So again, I'm still watching. There's a couple things I'm watching on the GLD chart. There's a inverse head and shoulders here. So you have a shoulder, head and shoulder here. And sorry about that little pop-up there as we take that away. But nonetheless, you can see the inverse head and shoulders here. We're looking for a breakout at this level, which would take us back to this previous high. Also, this is a longer-term bullish pattern on the GLD. So if you look at the big move up that we saw, even going back here, big move up, this is all inside bar bullish consolidation. And that also is choreographing a further move to the upside. So again, I'm continuing, I'm actively looking to buy more gold. I hold gold as a swing trade, but I'm also looking to buy more physical metals at this point. Because again, inflation is not going away. When you raise labor costs, like what is happening out there, businesses can't pass 100% of that labor cost increase off to consumers day one. It's going to be something that over time they pass along, which will, bring their margins back up, but it's going to essentially increase that inflationary pressure.
And that neckline that you've drawn there on that chart, where does that translate into spot gold?
The double top, the high of the GLD takes you back to about that 2100 high, which we hit, I believe, in 2020, right up here. So you're looking at, gold getting back to that point. Yeah. Eventually, it's going to go higher. I have like a 2-year price target around 2,800 to 3,000. I think once you get the momentum. So right now, you're seeing a lot of kind of, do I want to be in gold or do I want to be in Bitcoin, right? And we've seen Bitcoin perform really well recently. I think that's taken a little bit away from gold. But
just
my guess is
before we move on to the Bitcoin there, though, so just the chart line there on your lower trend line, what are we looking at there in terms of roughly in terms of spot gold? If we're looking for a retest and a break of that line, where does that?
I believe this is around 1850 or so. I could be a little off on that, but right around 1850 on that. So you'd need a decent move up about $100 in spot gold from where we currently are trading, which would take us to about 1850 right here. So that'll be that first big attack on this inverse head and shoulders. And again, if you break that through, you should get a pretty quick move up to this double top up around 2100 gold.
Okay. And talking about Bitcoin, we've seen a significant rally in Bitcoin of late. Is it a case that now people are focusing on Bitcoin as that inflation hedge?
Yeah, so there's definitely a camp where you're seeing inflation hedges being put into the Bitcoin trade. It's not just that, though. I mean, there's an incredibly bullish sentiment right now on Bitcoin. I think there's some manipulation going on as well with Bitcoin. The things that concern me about Bitcoin's recent run, number one, the volume is very light. Compared to previous bull runs, this volume is very light in Bitcoin. I've noticed how at certain key pivotal levels, it looks like the market makers are manipulating to push Bitcoin above the key level, which encourages new buyers to come on board. So I am continuing to be skeptical. I've said in the past that basically you have a level here. So you can see this is your neckline of that former head and shoulders pattern, which broke down to 30,000. You can see here we've hammered on it. We closed above it yesterday. We haven't confirmed yet, and we are pulling back today. So I'm watching very closely if we confirm. But if you look back at the 2013 cycle and the 2017 cycle, this is very reminiscent of those cycles. The only change in that would be if we took out the $65,000 high. Then you would say, okay, this wasn't the cycle high in early 2021. Instead, we'd look for a subsequent high pivot of the cycle before a bigger correction. I'm still in the camp. This is still a cycle high at 65,000, and I still have a price target of around 18 to 20,000 on Bitcoin. But again, you have to watch that 65,000 high. It will negate that if price takes out 65,000, then it no longer is reminiscent of previous cycles on Bitcoin.
But vulnerable to a downside correction still at this, you're not fully confident that that break of that trend line is solid.
Yeah, I mean, so one of the things, and these are games that market makers play and that institutions play, is they know these trend lines. And this goes for stocks, this goes for cryptocurrencies like Bitcoin and Ether. It goes for commodities. And what'll happen is they say, okay, listen, we know this trend line. What we're going to do is we're going to push it just above this trend line. And that'll encourage people to say, oh, this is a breakout. And you increase the bullish sentiment. And then you get a lot of new buyers to come in. And what does the institution do with all those new buyers? They're selling all their Bitcoin right into them at that point. So that's why I use a technique called confirmation, which is a secondary move above in one of the subsequent days that'll really tell me, okay, this wasn't just a flash in their pants type of close above where they're faking people out. There's actually some teeth to that move above.
Now, obviously, interest rates, it doesn't look like the Fed can do much with interest rates, but as we talked about already, the narrative that is going on at the moment is seeing the bond market do a bit of the work for the Fed. What's your view on Treasuries then at the moment?
So I think that there's probably further upside in Treasury markets as long as those inflation numbers continue to come in hot. I think that the yields will likely retest 1.75%. And I actually think there's upside till just over 2%. I think you'll go to maybe 2.1, 2.15% on the 10-year. That will contribute to the deleveraging in the market that should take us down substantially, especially on technology. But I do think that at some point when you get above 2%, the Fed is going to fight tooth and nail to make sure interest rates don't keep going higher. Whether or not they can win that battle, I don't think they can win the long-term battle. They might be able to win a few wars and keep it down for a certain amount of time. But again, you just have too much ballooning debt from the Federal Reserve side, balance sheet now at 9 trillion or something like that and continuing to go up. You have the government, US government debt, which is, insane at this point. And there's just a point where the inflation now, you have such high inflation. If that doesn't back off substantially back towards that 2% model, then again, I don't see how interest rates can be held down for very long.
That could suggest some serious problems for the Treasury then if we get interest rates over 2% with the level that the national debt is at now, and obviously significant knock-on implications for stock markets.
Yeah,
as we've discussed.
You're 100% right. And it's going to be one of these crazy situations. And again, I don't know if it's, a year from now or 5 years from now or what, but there will be a reckoning day where, the dollar will be questioned as not only the reserve currency, but just as a currency that holds, value for Americans. And you can't blame people for going towards cryptocurrencies or for gold or other metals to protect themselves. I mean, how do you pay a debt off when interest rates are being pushed higher, like they potentially can be? Yeah, it's going to be a messy situation. The timing is always the trickiest thing to figure out. Does the Fed have something else that they can maneuver? Can taxes be raised? And then does that cause other problems like, lower revenue potentially if taxes are raised, because it could hurt the economy? I mean, we always think that taxes being raised is a good thing for the economy, but it sometimes can actually hurt the economy, which results in less revenue for the government. So we'll see.
While we're talking about inflation, obviously a significant influencing factor are commodity prices, and we're seeing oil at the moment hitting a 7-year high. Yeah. What's the outlook for oil according to your charts?
So we actually hit a very key level on oil just yesterday, and today we're kind of kissing that same level again. I'm going to do my best to bring up that chart for you guys right now because I want to show you this. This is the USO chart, so this is what I'm basing it off of. And basically what you have is a trend line here, which you can see we bubbled up against. In fact, this looks very close. Bear with me while I get this line in here. This looks very similar to what I showed on the Nasdaq 100 chart here, where you kind of were bubbling up. And every time you hit this upper range, you see a big sell-off back to the lower range. So if we go back to the USO chart, look at this, upper range, and here we are again. So for at least for the short term, I'm bearish on oil. Okay. For me, I look at things like not only the charts, but you have this scenario where natural gas, the price of natural gas in Europe and around the world is causing major issues and increasing that demand for oil. However, we're starting to see natural gas coming back in a little bit. That should bring oil down just a little bit as well. The other thing that kind of concerns me about whether or not oil can go higher, and I'm in the bearish camp now, is that you have too many bulls on, like if you flip on CNBC, which is what we watch here, everything is about buy oil stocks, buy oil, commodities are going to go higher, especially oil. And anytime you notice this in history, it's usually a topping point. The talking heads usually kind of talk it up at the end of the move versus at the beginning. So again, I'm bearish on oil, and I do think we actually have a pretty substantial correction on oil, substantial being back to $70 to $72 a barrel from the current 81 to 80.
And do you have a chart there on natural gas? Because like oil, despite the fact that our community is very interested in gold and silver, everybody's interested in what's going on with the price of oil and the price of natural gas, because it's one of the first things that's going to hit our wallet. Yeah.
So here's the UNG, which is the ETF that tracks the natural gas market. And again, you can see it's had just a tremendous move to the upside. To me, notice the volume here, huge volume when we were making this top. That to me is a significant top in place right now. Even though it's pulled back, I still expect more downside, likely down to about here. I would say down to about 16 on this. I don't know what that equates to in the natural gas price, but I do think there's more downside here as you'll start to see governments making maneuvers to lighten the price of natural gas a little bit for the consumer, because really it's hurting, especially going into winter. You're going to have some major hardships for people out there around the world that heat their homes with natural gas or oil and so forth with prices here. I wouldn't even be surprised if the Biden administration is making a call to Saudi Arabia and saying, hey, listen, we can't have the economy hurt by oil prices. We need you guys to increase the amount of barrels per day on the open market just for the short term. Now, you could say that the Biden administration wants oil higher because it makes the switch to alternate energy more rapid. But at the same time, the Democrats here in the US, they have to be aware of the elections. And if you hammer the economy too much, you're then not going to win the next election. So there's a kind of a dance here where I think the Biden administration wants oil to be higher than it was maybe a year ago, but not so high that it ends up hurting the economy here in the US.
Sticking with that international theme for a minute, Gareth, can we look, or can I get your thoughts on China at the moment and Chinese stock markets and anything that you're seeing there of interest?
Yeah, I've been bullish on the Chinese stocks quite a bit over the last month or so. I finally got my big payday on Alibaba, which just ripped over the last week or so. It's pulling back a little bit. I sold my Alibaba position, pre-market yesterday when it was trading above 170, and it's already pulled back to 163. But I'm in the case where I think you have to stick with best of breed like Alibaba, Baidu, Tencent. But based on valuations, there is nowhere else in the world where you can go for the type of growth you can get from some of these Chinese names at the valuations that they're trading. I mean, if you compare an Alibaba to an Amazon, there's no contest in what has more value. Now, granted, the Chinese stocks do have the regulatory issue, but I think the same thing is going on in China that is going on with the oil price in the US, where the Chinese government doesn't want to regulate so much that the economy is hurt. And in addition, you have this Evergrande catastrophic kind of default looming, where it's really put a stop on new regulations coming out from the Chinese government because they don't want to have kind of a double whammy of a default and then new regulations hurting their economy. So I'm in the camp that I really like the Chinese stocks. I'd wait for a pullback on something like Alibaba to 150 or so. But I mean, if you have a 4-year, 3-year time horizon, I mean, these could turn out to be some of the best investments out there.
Anything in the overall index in the Chinese markets that's suggesting that there's a degree of nervousness still or persisting or increasing around the whole Evergrande?
Yeah, I mean, definitely. If you watch the Hang Seng market, last night it was down 400 points or so, I believe, and that was because Evergrande missed another debt payment. So I think there's kind of this reaction to new headlines like that. But so far, we haven't seen this affect the global picture. And I think, again, the Chinese government is making it clear they're not going to bail out international bondholders, but they're going to shore up their own economy to not let it feed into potentially a big recession there. So overall, I think at these levels, again, you're going to have these craziness moves because of, the nature of what's going on. But I think if you just have that few year out horizon, the Shanghai Composite looks very, very good, as does the Hang Seng.
Gareth, just remind our viewers where they can learn more about what it is that you do.
Yeah, so the best place to come and find me is on Twitter at Gareth Soloway. And again, I always recommend that because it's free. You can follow my tweets. I put out good charts, good setups, some interesting market commentary. And then if you really like that and you want the actual trades I'm taking as swing trades, you can always come to inthemoneystocks.com and sign up for my service there called Verified Investing Alerts.
Gareth Soloway, thanks for joining us again on GoldCore TV.
Thanks so much for having me. Have a wonderful day.
Thanks for watching. And if you enjoyed this video, you'll definitely enjoy these interviews with some of the leading voices in financial markets and trading. And remember, as always, if you want to see more interviews with industry experts and thought leaders in financial markets, subscribe to GoldCore TV and hit the notification bell now. And if you want to learn more about how you can buy, sell, and store physical gold and silver, log on to goldcore.com, your precious metals experts.